How safe are annuities, and what happens when your annuity company defaults? Hello, members, super savers, and bond course fans. I hope you're healthy and well. We've been speaking about annuities recently on this channel, and while they're not for everyone, they can provide a pension-like guaranteed income for life to supplement Social Security and other retirement payments. Now, lifelong income may sound attractive, but what happens if the insurance company that you bought the annuity from were to go into financial difficulties or even go bankrupt? So, with that in mind, here are the 3 topics that we'll be covering in today's video. 1. What happens if the insurance company you bought the annuity from defaults? 2. How do state guarantee associations work, and what are the protection levels? And 3. How bad or not bad are the historical default rates? And what's my personal take? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. What happens if the insurance company you bought the annuity from defaults? As a refresher, annuities are designed to provide a steady income stream for people during their retirement years. Annuities are generally used to address the risk of outliving retirement savings and will pay out for life, basically like a pension. There are 2 broad categories of annuities: deferred annuities and immediate annuities. With deferred annuities, you first save or build up the amount of money you will need to buy your lifelong income stream when you retire. Many people make regular monthly payments during the so-called accumulation period, basically like paying into a pension savings plan. But you can also invest a larger amount one-off and let it grow for a while before it's converted into regular payouts. This latter option with the initial lump sum investment can often be found in the form of a multi-year guaranteed annuity, or MYGA, and it can be particularly attractive if it's structured to grow on a tax-deferred basis until it matures and or the regular payouts begin. Now, with a MYGA and some other deferred annuities, you may have a bit of flexibility when they mature. You could convert them at this point into a lifelong income stream, but you also have the option of rolling it over into another annuity or even cash out at maturity. Moving on now to the second broad category of annuities, immediate annuities. If you want to convert a larger sum that you've already saved up into regular payments that start basically immediately, you would buy a single premium immediate annuity, or SPIA. Single premium immediate annuities can be a popular option to convert larger retirement savings from a 401k or similar plan into a lifelong income stream at retirement. For example, you could cash out all or part of your 401k, take the total amount, and invest it as one large lump sum into a SPIA that would then start sending you regular checks as soon as the next month. Check out these recent MYGA and SPIA videos here, linked below in the first pinned comment for more details, including who should and should not buy annuities in my mind. As I mentioned before, many investors really buy an annuity because they want regular monthly payments for life, much like Social Security or defined benefit company pension. That said, annuities can be very flexible in the sense that most annuities also allow you to tailor the payouts to your needs. You can take the payments for life or just for a certain period of time. The payments can be just for you or also continue for a surviving spouse. And you often can also choose whether your payments should be the same fixed amount every month or something more variable and flexible. Having many options is great, mind you, but it can also make things more complicated. So if you're looking for a customized annuity that's suited for your individual circumstances, goals, and expectations, drop us an email at jennifer@diamondnestegg.com so that we can connect you with our trusted annuity specialists. So for today's video, let's assume that you just bought an annuity that will send you and maybe your surviving spouse a guaranteed fixed check every month for life. So a guaranteed income for life. Sounds great, right? But what if something goes wrong? What if the provider of your annuity gets into financial trouble or even defaults? Let's begin by taking a look at how an annuity is structured from a legal point of view. An annuity is essentially a contract with an annuity provider, in most cases, an insurance company. This contract defines the rights that you have against the insurance company, and you can sue them if they don't make good on their promises. But an annuity does not give you ownership in any underlying assets. That's different from how a 401k or individual retirement account is structured, where you actually own the underlying cash and securities and keep these even if your employer or the firm that manages your account were to go bankrupt. In other words, with an annuity, you're really dependent on the insurance company to stay solvent and make good on its promises to send you those monthly checks. And to make it even more complicated, insurance companies are regulated on the state level, and there is no federal oversight or protection. The FDIC, the Federal Deposit Insurance Corporation, only covers banks, and there is no insurance scheme for annuities at the federal level. We'll dive deeper into how annuities are insured in the second part of this video. That said, there are two mitigating factors that should keep an insurance company from becoming insolvent in the first place. First, insurance companies usually invest very conservatively and with a long time horizon. They generally don't trade or speculate in markets too much, but rather try to build a portfolio that will match stable and predictable long-term assets with their long-term liabilities from annuities and life insurance. And this long-term focus also means that insurance companies don't have the risk of a sudden run, which is different from banks. Most banks actually fail if a bank run develops, if too many depositors want their money back from a bank at any point in time, as they're often entitled to. The bank may not have sufficient cash and liquidity at hand to pay out all the withdrawal requests and may have to declare bankruptcy. Such a bank run is exactly what happened at Silicon Valley Bank in early 2023, and it ultimately broke them. Now, a bank run can't really happen at an insurance company in principle because it's not just the insurance company who's committed for the long run. It's also the client. Neither an annuity nor life insurance will give you the right to suddenly withdraw all that you paid in before without charging you a hefty surrender charge. And there might be certain other conditions as well. So there's not really an environment for sudden panic-induced runs on an insurance company. Second, while insurance companies are not regulated or supervised at the federal level, as I mentioned before, they are still regulated and supervised at the state level. Every state, as well as DC and Puerto Rico, has a Department of Insurance, an insurance commission, or some similarly named body that regulates, licenses, and supervises insurance companies. These state regulatory agencies work together and coordinate among themselves in the National Association of Insurance Commissioners, NAIC, and the core principles of insurance regulation are more or less consistent across the nation. However, the states can and do add their own flavors, so to speak. Of course, good is often in the eyes of the beholder in the case of regulations, but free market think tank R Street, maybe not surprisingly, gives states such as Florida, Utah, and Texas better grades for market-oriented regulation than New York, California, and Massachusetts. And one important reminder here, always make sure you have a look at the ratings before you invest in a long-term annuity. Besides the three large agencies, S&P, Moody's, and Fitch, many industry professionals also use the ratings from AM Best, which specializes in the insurance industry. Basically, every serious insurance company will show their ratings on their website, such as MassMutual here in our example. That said, even low risk is not no risk. And it's always good to have a safety net, which brings us nicely to the next section of today's video. How do state guarantee associations work, and what are the protection levels? If everything goes wrong and an insurance company really runs into deep financial trouble, customers' claims are protected by state guarantee associations within their state. As I mentioned earlier, every state, as well as DC and Puerto Rico, has a state guarantee association, and they coordinate nationally within the somewhat unwieldy named National Organization of Life and Health Insurance Guarantee Associations, or NOLGA for short. These state guarantee associations, or SGAs for short, function on a fundamental level much like deposit insurance. But there are 5 key differences versus how the FDIC works that you should keep in mind. 1. You will generally be subject to the rules and limits of your state of residence at the time the insurer is declared insolvent. This applies regardless of where the annuity or policy was purchased or where the insurer is headquartered, and you can only submit claims with one SGA. The good news is that your in-state SGA will also be your single point of contact, and you don't have to bother with dealing with other states' associations, even if your insurer was headquartered out of state. All SGAs will coordinate among themselves with the help of NOLGA. 2. The SGAs generally cover all types of annuities, including both fixed and variable. However, for variable annuities, only the guaranteed minimum backed by the insurer's general account is insured, which is a technical way of saying that SGAs will always cover your guaranteed minimum, but not market losses. That said, any market gains in your aggregated account for a variable annuity should still be yours, as long as the securities are still there and valuable. 3. To find out the maximum protection limits for your state, you can use this webpage from NOLGA, which I've linked below in the first pinned comment. Just click on your state of residence, and it will give you a good overview. For example, in this screenshot where I clicked on New York, you can see down here that annuities are protected by up to $500,000 in New York. Now, New York at $500,000 offers the highest protection level currently available. As a general overall benchmark, many states insure annuities up to $250,000. And as always, please do also check with your state's SGA directly to confirm the limits and any other conditions or limitations that may apply. 4. All products from the same insurance company will be added up and count against the maximum protection level. If you want to get higher overall coverage, you will need to invest in multiple annuities with different insurers. And if you're thinking about buying annuities from multiple insurance companies, always make sure that they are licensed in your state of residence. 5. In principle, the SGAs will automatically spring into action when an insurer gets into financial trouble, and you should not need to take any immediate action. That said, while the FDIC prides itself on providing seamless service to the customers of a failed bank, usually the ATMs work again the morning after an FDIC takeover, this could, at least in theory, take a bit longer for the SGAs. And it's not just that the SGAs need to coordinate across states. The SGAs may also have more limited liquid funds ready and may be dependent on post-insolvency assessments, where they charge a special levy on all insurers in their state to cover the losses after a default has already happened. In contrast, the FDIC is pre-funded by quarterly premiums from member banks, as well as backed by a U.S. Treasury line of credit. Insurance companies don't operate ATMs though, so they can sometimes be a bit more flexible with timing. So now that we understand what would happen in principle to your annuity in the event that your insurance company were to go under, let's move on to the next section of today's video. How bad or not bad are the historical default rates? And what's my personal take? Despite some differences between states, as we just explained, the naturally more conservative business model of insurance companies, together with the supervision by the state regulators, seems to have been historically sufficient to make insurance the industry with the lowest default rates. This alphabetical list from S&P Global's 2024 Annual Global Corporate Default and Rating Study shows that the average default rate over the more than 40 years from 1981 to 2024 for insurance is just 0.23%, the lowest default risk of all the industries tracked by the study, with even zero defaults in 2023 and 2024. And while we're at it, financial institutions are the third least risky industry in this table, and with an average default rate of 0.61%, just behind utilities in second place with 0.43%. Nonetheless, to say it once more, low risk is not no risk, and even the SGAs have been battle tested in the past, so to speak. NOLGA gives these statistics on their website, which shows that in the 41 plus years of its existence, member SGAs have so far protected more than 3 million policyholders, guaranteed $27.75 billion of benefits, and paid out $9.25 billion in funds to consumers. As I always say, everyone's financial journey is different. Annuities are not for everyone. Almost no investment product really is. But if you want a lifelong guaranteed income that can supplement Social Security in retirement for you and possibly for a surviving spouse, then annuities may be the most attractive option available if you don't have a company pension. There is always residual risk, and no one can predict the future. But the inherently conservative, long-term oriented business model of insurance companies, together with the historically low default rates of this industry, would give me personally sufficient comfort that I felt I could rely on annuities for my retirement. Of course, I would also make sure to buy my annuity from a well-rated and respected insurance company and a financial advisor that I trust. And of course, also be certain that I stay within the coverage limits for the SGA in my state of residence. And as I mentioned earlier, if you want to get connected with our trusted annuity specialists, then reach out to us at jennifer@nestegg.com or check out this video here to see who should or should not buy an annuity. All right, members, super savers, and Bond Course fans, I hope you enjoyed this video and learned something new. And see you again very soon with more brand new wealth building content for your financial journey.